I'm Ann Petrick, Senior Director of Research at Vistage Worldwide, and I'm happy to host the latest webinar in our Peak Performer webinar series. This series is designed to support your leadership climb by bringing the most trusted experts to the Vistage community, those who provide exceptional insight and best practices to help you navigate new challenges and opportunities. Today's focus is on the key value drivers for any business and how you can tangibly impact those, whether you're starting to prepare for an inevitable exit or looking at how to improve the overall value of your business. We've invited Bob Hild, Chairman and CEO of ACT Capital Advisors, to give us a deeper review of the 7 key actions to maximize your business value. Bob's expertise lies in the investment banking industry with a focus on business development, entrepreneurship, raising capital, acquisitions, and team building. Prior to joining ACT 12 years ago, Bob co-founded Invest West Capital LLC, a West Coast-oriented private equity firm focused on mid-market acquisitions. Bob, I'll turn it over to you.
Thank you, Ann. Thank you for the kind introduction. And it's really a pleasure for us to be here this afternoon and participate in Vistage's Peak Performance webinar series. Many of you will only have the opportunity to sell your company or build a company once in your lifetime. If you're lucky, if you're a serial entrepreneur, you might do that 2 or 3 times. I've been blessed and fortunate enough to do that over 60 times. First, as a partner in a private equity firm, we bought and sold over 60 companies during that period of time. And the other balance of my career I've spent in the brokering or investment banking space, and where I've conducted over 100 transactions. So I've had a lot of, and also one last thing, as a private equity investor, I actually ran as CEO of 5 of our portfolio companies. So I know and understand what you go through on a day-to-day basis. I've had those sleepless nights wondering if I was going to make payroll the next day. I've had those challenges of angry calls from customers at 3 in the morning. So I have been there and done that and have had that experience. I'm going to bring that experience to you today with these 60 plus transactions I've been involved in personally as an investor. I can tell you I've looked over at thousands and thousands of businesses as an investor, and I have, through my period of time, condense that down to what I call 7 really key action items that maximize the value of a business. These are the 7 key things as a buyer in particular that I'm going to be looking at when I evaluate your company. Oops, not getting it. There we go. So today, in addition to discussing the 7 key action items to the business valuation, we're going to discuss a little bit about ACT. I'm going to tell you a little bit about us. I'm going to take a few minutes to talk about the current state of the M&A marketplace and what's happening out there today. After we discuss the 7 key action items to maximize business value, we'll actually run through a case study of ours, a company we're going to call Starfish, a company we sold during the pandemic. And then finally, and lastly, number 5 is we'll have a Q&A session. And as Adam mentioned in the beginning, if you have questions that come up during the presentation, please feel free to go to the Q&A section and type in your questions, and we'll curate those questions, and I will answer as many as I can at the closing of this presentation. And those that I don't get to, I'm happy to answer offline. So who is ACT? So let me tell you a little bit about us. I acquired ACT Capital Advisors in 2010. And I did so at the time I bought ACT Capital. We had 2 locations. We had 5 professionals, and we had 5 professionals and 2 locations. Get that back there. And today we have over 15 locations. We have over 40 professionals. We were a regional M&A advisory firm. We're now a national advisory firm. We're still completing and filling out our growth plan and scaling out our business model. But we've seen significant growth. A little bit of experience that I had as a CEO of all the companies that I ran as a portfolio company, the worst performer, I was able to quadruple the return on investment in a 5-year period of time. So I've had that experience. I know how to grow a company, know what to look for. ACT Capital Advisors, we have 8 apologize. We have 8 industry sector groups that we highly specialize in M&A in each one of these areas. In fact, yesterday we closed a deal in the transportation logistics space. Last month we closed a $100 million transaction in the construction space. And I personally have closed deals in almost every one of these sectors, but we actually have professionals that specialize in each one of these. And in our 37 plus years of experience, we have certainly closed deals in almost any sector of the world of the business, in all business sectors, excuse me. So let me just spend a few minutes and give you a little update of what's happening in the M&A world. I get this question a lot. One of the first things I get when I talk to potential customers is this the right time to sell? What's the market like? So I want to take a few minutes here and discuss that, just give you a little primer of what's happening. So I really want to focus, I'm going to throw up some other statistics here in a second, but I really want to focus on just the trajectory of this graph and the timing of it. As you see on this graph, you see this drop in Q2 of 2020. Well, that's obvious to all of us, right? That was the first quarter that the pandemic really sunk in. And, we started to feel it maybe the first quarter, but by the end of March, we knew we were in a pandemic. And we started basically for the first time in history, shutting down our economy. And we actually intentionally shut down our economy. And we never knew quite how we were going to recover from that. It was a scary time for many of us, for sure, even for us. I mean, we saw 7 transactions that were supposed to close at the end of March of 2020. Out of those 7, only 1 closed. Okay. And it took the rest of the year. By the rest of the year, we closed 4 out of the remaining 6, and now we've closed the other 2. But a lot of those deals got pushed out to the side. And you can see that here in this graph. You can see how it dropped more than half by Q2 of 2020. I'm going to throw up some of these other statistics so you can just see some numbers here to go along with this. Whoops. Go along with that. I'm sorry, I went one too many. Okay. And you can see on these statistics, you can look at them, you can see the growth and the change. But the bottom line is from Q2 of 2020 to Q2 of 2021, 1 year, we've gone to a 300% increase in M&A activity. And we're actually 50% above where we were historically. There is a tremendous amount of M&A activity going on. We can see that anecdotally within our own firm. We have over 60 clients. We normally have 20 to 25. We have 60. We have like 15 transactions are supposed to close between now and the end of the year. And I think the biggest challenge we're going to have in getting deals closed by the end of the year is having enough professional help, enough CPAs and law firms that can assist us to get those deals and transactions done by the end of the year. So with a robust M&A market, what has it done to multiples of EBITDA? Now, many of you, I'm sure, understand what multiple have heard or understand the term multiples of EBITDA, but let me just take a second and explain what that is. EBITDA stands for earnings before interest, tax, depreciation, and amortization. It really is a true reflection of your cash flow pre-tax. Okay, you take that number and you divide it into your valuation, you end up with a multiple. Okay, and that multiple is a number that is used frequently in the industry. What's the multiple of EBITDA for this business, for the size of this business, for the industry sector that it's in? And we'll talk here in a second, and we'll see how size really matters, industry sector really matters as multiples go. But what I wanted to show on this graph more than anything else is that we hit a all-time record in 2019, the highest multiples paid globally. Now, these numbers here are on global transactions. These are all transactions done. Okay, so there may be a little bit misleading, but we'll talk about in a minute when we get down to businesses that are more closer to your size. But the reason I threw this slide up here is really just to see the trajectory of what's happening with EBITDA during the pandemic and post-pandemic. And you see it dropped a little bit, but we see it coming back up. And so long as interest rates continue to be low and the amount of capital is still available out there, we believe the multiples of EBITDA are going to continue to climb in 2021, 2022. So let's get a little more realistic here and talk about drivers that are maybe that are the M&A multiples that are more practical to your industry and to your size. So this graph here represents companies with sales between 5 and 50 million. Okay, which I believe is probably most of you on this call, your companies are somewhere in that 5 to 50 million in revenue range. Okay, the median, as you see it by that blue line across the bottom there, is 4.4x multiple of EBITDA on companies in this size. But as you can see, not all industry sectors are created equal. If you look at the 19.1, that's your information technology sector. Probably no surprise there. Those models are extremely scalable, highly marginal revenue that equals high marginal profits. So that industry is going to continue to do extremely well. But you also see some industries, if you look down here, towards like healthcare and social assistance industry, that was heavily impacted by COVID. The healthcare industry, in particular, assisted living and so forth, heavily impacted. You see the valuations have dropped in the past year as a result. So what are the factors driving this market? Well, we certainly have seen an improvement in the economy. It really truly was. If you were not in the hospitality, transportation, travel industries, restaurant industries, you have seen a V-shaped recovery. I'd say almost all of our clients have had a better year in 2020 than they had in 2019, believe it or not. And if those that didn't are actually having a better year in 2021 than they had in 2019. So they already have recovered from COVID and are actually, their biggest challenge is not revenue. A lot of them are really suffering from indigestion, more so than they are from lack of revenue. And indigestion being, as you well know, as many of you are probably struggling with the supply chain issues that are ongoing right now, and having orders and not being able to complete those orders on a timely basis. That's the biggest challenge most companies are facing today. Availability of investment capital. There's so much money available. The demand side is incredible. I mean, look at this. Private equity firms have 1.7 trillion. That's trillion with a T, folks. $1 trillion of dry powder. That's money that they have in the bank that they need to invest, that's uninvested yet. They need to get invested. Now, the average lifespan of a private equity fund is like 7 to 8 years. Now, so let me put this a little bit in perspective. 1.7 trillion. In 2019, the private equity sector invested $500 billion. Okay. That is basically 1/3 of what they have in dry powder. Or in other words, they have 3 years of dry powder. And they've got to get that capital invested and returned to investors within a 7 to 8 year time frame. So they're already way behind the 8 ball in getting that money invested and getting the returns. They got to get north of a 20% return on that invested capital, if they're going to have any chance of raising another fund, their next fund. So there's a tremendous amount of pressure on the private equity sector to get capital invested. Now let's talk about corporate America for a minute. You thought that the private equity had a lot of capital. Corporations have over 4 trillion of excess cash on their balance sheets that they're trying to figure out what to do with. And they're loath to dividend that back out to their investors. They want to find a way to take that capital, to utilize it for growth, and to expand shareholder value. And in a recent Ernst & Young survey, 75% of Fortune 5,000 CEOs said that M&A, merger activity, acquisition activity in the next 3 years is their top priority in their strategic plan. 75%. That was up from 32% prior to the pandemic. Okay, so you can see what these CEOs are going to do with that capital is are looking for acquisition candidates. Okay, what else is driving the market? Low interest rates from the Fed. So long as capital is cheap, borrowing costs are low, it makes the acquisition costs lower. It's going to drive prices up higher. Declining, just the overall sentiment of the marketplace. I mean, unemployment's declining. People now see that beyond the pandemic, we're through the tunnel. It was a light at the end of the tunnel. We're now kind of through the tunnel for the most part. And so people are much more optimistic. Consumer confidence is high, business owner and investor confidence is high as well. And lastly, we have this aging baby boom generation, which I'm part of, and maybe many of you are too. And we're at a point, and many of us are at a point where we're saying, hey, I've been through 3 or 4 economic ups and downs in my lifetime. This one is enough, and I've got enough. I'm ready to retire. I want to move on. And we're hearing that more and more from our existing clients, our new clients that are coming on board. I was asked the other day by a tax professional, say, are you getting a lot of these new clients because they're really concerned about taxes going up in the future? And I said, well, that's part of it. But we probably only have 4 or 5 clients that said, if we don't sell our company by the end of 2021, at the end of this year, we're done. All of them are saying, I hope you can get it done by the end of this year, but if you don't, I still want to sell. So there's a driving factor of aging baby boomers who are just saying enough's enough, and I've made enough money, and I want to see this company move on to another successor. Okay. So here's some quotes. Just now, you're not taking it from me. Here's some quotes from people in our industry. This is Stuart Cole, who's co-founder of Riverside Capital, which is a private equity firm. He says he's bullish on this year, particularly for those companies that performed well during COVID. And you know what? Most companies did perform well during COVID. That's a kind of a secret that most people don't really realize. Here we have a quote from Heather Madlin of Heron Partners. And she says, baby boomers have lived through enough cycles and pandemics, and they want to sell. That's the anecdotal information I'm receiving as well. So she's just correlating that for me. And then we have last a quote from Graham Fraser, is a private equity partner in Capital Research Partners. I've met Graham on a number of occasions, attended a couple of his seminars. And he's saying, hey, look, the challenge for the M&A market is not the amount of capital. There's tons of capital out there. The real challenge right now is there's a scarce number of high quality deals that are worthy of investment. And this is a key factor. We found this to be true too. I just mentioned a minute ago that we sold a construction company for roughly $100 million to a Canadian company during the month of September. That client came to us during the pandemic. And he said to me, Bob, he says, I'm going to wait till the pandemic's over. Only people buying businesses during the pandemic are people who are looking, or bottom feeders looking for super great deals, or they're companies who are desperate to sell. Is I'm not desperate. I'm making more money than I know what to do with, and my backlog I got over a $2 billion backlog. I'm in great shape. So why would I sell now? I was able to convince him that that's exactly the way most quality companies are thinking. They're thinking, I'm going to wait this whole pandemic thing out and just wait to see what happens. So therefore, there are fewer quality companies in the marketplace, and yet you got all this capital out there chasing and trying to find those deals. So we're able to, I'm glad he took my advice. He stayed on. We sold this company and got a phenomenal multiple for it. And he's happy as can be. And found a great buyer, great strategic buyer for him. That wouldn't have happened had he waited. Okay. So I know most of you came here today to listen to me talk about what are the key action items, the 7 key actions I've kind of refined over my lifetime that create value for businesses. And again, this comes from my experience as a private equity investor, also as a performing CEO, as well as being an intermediary. So let's start. I'm going to give you a quick overview of the 7, and we're going to go a little more detail into each one of them. So strong secondary management team. You cannot be so important to the business that when you leave, the business falls apart. You got to have that secondary management team. I'll talk a little more in detail why. Secondarily, your company needs to be on a growth trajectory. Buyers are not interested in buying companies that are flat or have declining revenue or growth. Barriers to entry. If you can create barriers to entry, that usually allows you to have market share or be the market share leader, as however you define it. We know that market share leaders garner higher profitability for many reasons. We'll talk about that a little bit more in a minute. Do you have the ability to increase margins and profits, or have you been increasing your margins and profits, or are your margins and profits declining? Okay. Again, back to kind of the growth thing. If your margins are declining, that's not a good thing, and buyers don't like that. Minimal customer concentration. I get it. You started the company. You probably started with one client. That client grew quickly, or your services or products grew quickly. You had a tiger by the tail. And you're doing everything you can just to keep up with that one client. And you may be that today. And that becomes a real challenge when you have that tiger by the tail to diversify and get additional customers and have a real diversified customer base. I get the challenge. We'll talk about that a little bit more in a minute. Recurring revenue streams. You want your revenue streams you want to have some portion or a good portion of your revenue streams in a recurring model. Recurring meaning, I'll use two examples on the extreme. On the one extreme, you have subscription agreements like your Microsoft, maybe many of you use, like we do, Microsoft 365 Office Enterprise Edition, right? So you pay so much per person, per seat, per month. And that's a subscription model. And those are highly valuable. They're very predictable. They're very consistent, and they're very sticky. Okay. To the other side, you have contract. I say a contractor, a construction contractor, who's only as good as the last contract that he won, or is only as valuable as the backlog of contracts he's been able to amass, right? So, and you're only as good as the last contract you won. So you're constantly battling every day in and out to win another contract. That's at the other extreme. Very hard to predict, very cyclical, and buyers just don't, investors really don't like those, okay? Prepared financials. Lastly, you'd probably be a little bit surprised maybe to see this one on here, but this is so important. Have your financials prepared by an outside CPA, and we'll talk about that a little bit more in detail. So let's jump into the first one here. Strong secondary management team. Why does a buyer want a secondary management team? I hear this all the time, and I also get it too. I mean, you've founded this company. You're chief cook, bottle washer. You've done it all. There's everything you do, and you do it better than anybody. And I get that, and it's probably true, right? But if your company is solely dependent upon you doing all those things, a buyer, what are they going to have after you leave, right? They have pieces and fragments, but they don't have the engine that runs the business. So you need to develop that strong secondary management. And I have a lot of buyers or a lot of clients that come to me and say, why do I need to do that? Because the buyer is just going to bring his own people in and do his own thing. And that's a big assumption. I hear that all the time. And that is such a bad assumption. It's rarely the case. Buyers do not have secondary management teams in waiting. Private equity firms don't. They're just investors. They just have capital. They want to deploy capital investment. They're not bringing in a whole team to run your business. Same with a strategic buyer. Strategic buyer is busy running their own business. They don't have a team sitting here on the side ready to just jump in and run your company for you. Okay, so they don't have a team waiting on the sideline. And also, so secondarily is this continuity and risk reduction. Buyers want to reduce their risk, and they recognize the management team is so important. So keeping those people on there because of their, perhaps their customer supplier relationships that you have, the tribal knowledge of the business. I mean, the management team understands your business inside and out. And so that tribal knowledge needs to stay there. The loss of that is huge. We want to reduce employee turnover. If you come in and you change out the management team, you don't have management team, you bring in a new one. Well, a lot of your employees may not be happy with those people. And you're going to have employee turnover. They're going to leave, and some of your best people will leave. And that's the buyers. That's a huge risk. They don't want to take that risk. Okay. This is the team that got you there, right? This is the team of people. You've grown this team, hopefully, and they've got you to the success that you're achieving, and hopefully beyond. So the buyer wants to go with that team that has helped create that success. So how do you know if your business is too dependent upon you? Okay. Here's the key test. Very simple question. Can you take a vacation? And if so, how long can you take that vacation? I would tell you, if you can only take a vacation for a week, that's not long enough. If you can take a vacation for a month or even 2, with just a phone call here and there back to the office, and everything runs well, then you've developed a strong management team, and that management team is capable of carrying on the business. You want to make yourself, as crazy as this may sound, and maybe counterintuitive, you want to make yourself as irrelevant as you possibly can to the business. The buyers want to know that there's a strong team that's going to run this thing after they buy it. So what does a quality management team look like? Now, many of you may have read the book or seen the videos published by Jim Collins, or read his book, Good to Great, or a number of other books that he's written. But he has this concept about getting the right people on the bus. Okay. And not only just getting the right people on the bus, but you got to get those people in the right seats. Okay. That means you got to have people who have the right skill set, that you're playing to people's strengths, not their weaknesses. And that's I'm just going to add a little editorial. That's a little bit of a challenge, because sometimes we want to see our people with their weaknesses. We want to see them improve upon their weaknesses. And that's actually counterproductive. All the research has shown it's better they focus on their strengths and let them do what they do best, rather than them trying to make their weaknesses stronger. And let somebody else fill in where their weaknesses are, okay? Accountability, man, you need people who are accountable. People who are results-oriented, problem solvers. They don't take excuses. They don't point fingers. They take accountability and responsibility for their role and their seat on the bus. They want people who understand your mission and the vision of your company and who are on board with it. You want team players, people who know how to play in a team concept that everybody brings value and worth to the team, and not somebody who's a prima donna. You don't want any prima donnas on this bus. Prima donnas are toxic. I'm sure some of you have had some of those. They're toxic. Yes, sometimes they're in key positions and they're tough to get rid of. I understand that. I've been there. And you want people on the bus that champion your company goals, that enhance your company culture, and our ultimate team players and champions of your company and of your brand. Now, the inverse is also true. You want to get the wrong players off the bus, right? Wrong players are demoralizing to the rest of the players on the team because they know. The players on the team know who the weaker players are. And they're going to sit there and wonder why you, as the coach, is allowing these weaker players to still be on the team. He's bringing you down, and it demoralizes the team, and it can sometimes become toxic. Now, I get it here too, folks, because I've been there. I've taken over companies where we had key people in key positions that were, maybe top performers, right? But they were in the wrong seat they're not on the wrong seat. They're not on board with everything, and they're toxic to the business. And sometimes it could be as simple as somebody who was there in the beginning of the business and grew with the business, but the business has now outgrown their capabilities. Or it could be a family member, and frankly, this is often the case. These are family members that are in these positions, right? And how do you remove and change a family member, and still have them coming over for Sunday dinner? Tough. Right? But these things need to be done. Now, I've had clients to say, well, you know what? I'm just going to let the buyer figure that out and take care of it. Well, you know what? Buyers aren't dumb. Okay. They're going to figure that out. If they don't figure it out before they give you a letter of intent, they're definitely going to figure it out during due diligence. And they're going to know who the weak players are. And they're going to come back to you and say, why have you not made this change? And you're going to say, oh, well, I couldn't do it. And they're going to say, well, this person is creating a toxic environment. Therefore, it's increasing my risk, and I want to restructure my transaction with you to reduce my risk. Okay. So don't want to have that happen. You don't want your company to ever be perceived in a bad light. You've got to get those bad people. And as painful as it is, you've got to find a way to get those wrong people off your bus. All right. I'll share a quick story on this. A trucking family business down in Southern California, nice, large Italian family, had 3 members of the family involved in the business. Fortunately, in this case, the owner knew that he had a problem. And he came to me and he says, Bob, look, I've got a problem. First and foremost, goal number was, I got to have all my kids coming over to dinner, Sunday dinner, or my wife's going to divorce me, right? So that's her number one goal objective, is whatever I do when selling my company, I got to make sure I keep everybody happy, and they all still come back for Sunday dinner. But unfortunately, he had several of his kids in the business that he knew were underperforming. And really weren't passionate about the business. And that's why he wasn't going to sell it to his kids. He said, my kids just aren't passionate about it. They don't have that same drive, that same entrepreneurism that I have, and I'm paying them twice as much as they should be for the position that they're in, right? So long story short, we brought in our consulting group. We put together a consulting house, and we helped him structure a transaction before selling, a transaction that would benefit his kids. He was able to take a certain part of the purchase price. So look, I'm going to give this certain percentage of the purchase price to you guys when we sell the company. Okay. And I'm going to take a certain portion of my proceeds, and I will help you start a new business in an area that you're passionate about. Because I know you're not passionate about trucking. Okay. And he was able to successfully, and we used us as the bad guy. So we're the sheriff. Okay. We're the bad guys. We came in, we delivered the bad news. And then the dad was able to come and put swab on the wound by saying, hey, look, kids, this is what I'm going to do. And I'm going to fix this all for you, so you all be taken care of. I tell you, that worked. All 3 kids, they all 2 of them with a big sigh of relief. Oh, I'm so glad to get out here. I mean, I'm making so much money here. I could never leave. And I never wanted to disappoint my dad, but this isn't my passion. I really don't like the trucking industry. right? I really wanted to do something else. And so the dad was able to help them, as well as some of the money they received, to start a new venture. A great outcome in that situation. So let's talk about growth and scalability. As I mentioned earlier, the last thing buyers want to buy is a company with revenues that are going in the wrong direction. Now, some of you may say, well, my revenues may have dropped during COVID. How's that impacting things? That's almost a little bit separate conversation. But I can tell you right now, if your numbers are back on track since pre-COVID numbers are back on track, nobody's going to worry about what happened to you during COVID. Okay, those numbers will be discounted, and valuations will be modified to take out or eliminate the impacts of COVID, so long as you've demonstrated that you have come out the other side of it. Okay, so we'll put that to rest. But you need to have a company whose revenues are heading in the right trajectory. If they're flat or going down, very, very difficult to sell. You're going to sell at a discount. You're going to be perceived as a turnaround situation. So you're going to really sell at a significant discount. So what are you doing, to increase revenues? You should, I have this problem often with clients, is when they decide to go to market, they kind of take their foot off the pedal, right? They kind of start to relax a little bit, and they stop, or they have been for the last few years, and they kind of stop being innovative, and they stop looking at new markets, and they stop creating new products or services, and they just start milking the cash cow of what they have. And unfortunately, buyers see that, and they'll see right through it. And again, they're going to see it as a turnaround situation. You got to stay on top of innovation. You got to keep that gas pedal to the metal, keep it on the floor, and keep it going. They want to see that growth opportunity that your company's taking advantage of and is at the forefront of those things, and not just lagging behind. So you can develop new products and services. You can employ new marketing strategies as well as a possibility. And how has your company been impacted by COVID? I mentioned that just a minute ago, but a number of companies were like ostriches. They put their head in the sand and buried their head in the sand and hoped that it all blow over, right? So that's one group. Then there's another group that said, this is really an opportunity. How do I take advantage of this? How do I create new products or services to meet the new normal, the new needs of my clients? How do I take advantage of my clients who put their heads, not my clients, my competitors, who put their heads in the sand? How do I take advantage of that? If you were able to do that and demonstrate that you came up with new strategies and new products or new ways of doing business during COVID, I tell you, you're going to be loved by the PE and the strategic buyers. They want companies that were creative and innovative, and now have taken what they learned from COVID and intertwined it into their strategy, made it part of their strategy going forward. Businesses that scale. I tell you, companies love businesses that scale. They have the ability to scale means the ability to increase revenues generally with very little cost, and be able to grow without having to generate a tremendous amount of CapEx. But scaling sometimes requires that. So buyers love companies and business models that can scale. How can you? So you got to look about, how can I scale your business? How do you rethink your business and scale it? I had to do that when I bought ACT 10 years ago. I had to rethink our business model and say, how can we scale it? And so people ask, well, how did you go from 5 people to 40 people and 2 offices to 15 offices? And actually, we'll probably double that in the next 2 years. It will probably be, 25, we'll probably be around 25 offices, and we'll probably have, 60 to 70 professionals in 2 years. How are we doing that? Because we set up a model that was scalable. I won't necessarily go through all the details of how we did that, but we looked at the business and say, how can we better meet our customers' needs, and how can we better meet our investment bankers' needs, and do that in a model that allows us to scale. And we were able to accomplish that. But you got to kind of think, you got to rethink your business. Sometimes you might have to go back to scratch and say, how do I recreate this? Look at Microsoft. Here's a couple of quick examples. I'll use this first one here. Microsoft. It was just only a couple of years now. Well, maybe not a couple of years ago now. 10 years ago, how did you get your Microsoft product? You went down to Best Buy, you bought a box. It had CD-ROMs in it, and you downloaded them on your computer, and you paid $200, $300 for it, and now you had it. It was one-time purchase, and now you've got it. It's on your computer, and as long as you kept that computer and maintained the updates until eventually Microsoft eventually planned obsolescence in it, but it lasted you for a few years, right? Then Microsoft got smart about it and said, why don't we just change this to a subscription model? So like now today, I mean, my company, where I mentioned earlier, Microsoft 360 Enterprise Edition, I don't know, it cost me, $15-20 to add a new person, a new seat to our licensing agreement. But that licensing agreement just is monthly. I don't know, we're paying $400 or $500 a month. I don't know what it is, but every month, and you're probably doing the same thing. Maybe it's your home version, you're paying $10-15 a month, and you're on that kind of a model, on a subscription-based model. It's extremely profitable for Microsoft and very easy to use for you. You're always on the latest and greatest, and you always got the best updates, yada, yada, yada. So it's a win-win situation, but they've converted that from a one-time sale now to a subscription-based model, okay? Now I have another client. We're going to talk about Starship here in a minute. So this is a little bit about, Starfish. A little bit about Starfish here. Starfish is a consumer products company in the plumbing space. The inventor invented some products, patented them, and then he had a decision to make. He was making them in his garage. And he said, well, I can continue to make them in my garage, but I need a bigger manufacturing facility. So I could go out and buy or rent a manufacturing facility and set manufacturing. But I don't know what my capacity needs are going to be, how fast I'm going to grow. And so planning was really, really a challenge. Or he can go offshore in this case, or find a subcontractor and outsource the manufacturing of his product. And he's found that he could outsource the manufacturing for his product for cheaper than he can make it, and they could scale with him. So this created a scalable model for him. He was able to ramp up sales. As sales ramped up, he was able to fulfill those orders with this very scalable model of manufacturers who were manufacturing his product and shipping them overseas. They went into a 3PL and shipped out from there. Great slick model. Didn't have to invest heavily in property, plant, and equipment. Let somebody else do that. Okay. Barriers to entry. One of the keys to success is market share leadership. You want to be the market share leader. Now, you can define your market in many different ways, but however you define it, you want to be that market share leader. Why? Because we know that market share leaders get outsized profits and profitability. We know that sales become easier. Their brand recognition, their brand is bigger in that marketplace. More sales just naturally become like a magnet. Sales start to draw to you. You have to spend less time trying to go get them. And you gain a reputation for being the best because you are the market share leader. You probably got there because you're doing a lot of things right. You get that reputation, and you can charge more for your services as a result. Okay, so you want to be the market share leader, and this goes back to Jim Collins. He talks about this as well. You want to be the market share leader in that defined market. However you define it, be that market share leader. Okay, and you want to do that. You want to try to create barriers to entry, and barriers to entry can come in a lot of different ways. They can come in patents, such as intellectual property rights, copyrights. You can get you work on legislation to create barriers. You can be more innovative, and with your innovations, create barriers. You can create barriers through your brand loyalty, then your brand recognition within your marketplace. The cost of entry, you can make it very expensive for competitors to come in and effectively compete with you. And you see industries that are able to do that. For example, construction companies sell for a very low multiple. Why? Because every chuck in a truck can become a contractor. There's just really no barriers to entry there, right? But what about silicon chips? It costs billions of dollars to create a fabrication plant. So there's only very few companies, and that's why we're seeing one of the reasons we're seeing a chip shortage these days is because the upfront investment to build a plant is in the billions of dollars. So it creates barriers to entry for other companies to come in and compete. All right. So I'm going to share one quick story of a home health care provider that we represented a couple of years ago. Her name is Sally Coomer. She provided a home health care assistance to families with children with disabilities. She was the market share leader here in the Pacific Northwest in this space. About 10 to 15 years ago, there were unfortunate events occurred where it became people were prosecuted for healthcare violations and abuse of patients, right? And as a consequence, the state put together a blue ribbon panel to create rules and regulations. It was relatively unregulated industry. And Sally was smart enough to get herself to be the head of that blue ribbon commission. And she helped develop the new licensing requirements for home health care providers. So what she did by doing that, she actually created barriers to entry, made it very, very difficult now for someone to start from scratch and get all the licensing that they needed to be a licensed healthcare professional, and certainly can do it as a one-off individual. So by creating those barriers to entry, which she didn't really do it for that reason, she did it to make her industry better. But what it did was the unintended consequence was it made it very difficult for competitors, large national competitors, to come into the state and compete with her because they couldn't do it from a startup perspective. It was just too costly and too expensive. So it's much easier, better for them to actually buy somebody. So we were able to actually sell her company for probably 2x. I mean, I say a multiple that was 2 times 100% higher than what industry average in other states, because it was so hard and difficult to become into the state. So it created a barrier of entry, which she benefited by many millions of dollars. Okay, just like we talked about with increasing revenues, let's talk about actually your profit margins for a second, because the buyer is going to look really, really closely at your historical and your current profit margins and see what's been happening with your profit margins. Are they increasing? Or are they decreasing? And there's only really a couple of ways you can impact margins, right? You can either increase the pricing on the one end, or you can reduce costs on the other. And I would hope that as a part of your annual budgeting and planning process, that you take the time to analyze the profitability of every one of your products, and you look at the margin, the contribution those products are making, and looking at how can I improve my cost side of that equation, and how can I increase the pricing side. So let me tell you a little story of a woman who came to us with a very high recognized brand in the Pacific Northwest in the confectionery candy industry. And she came to us. We did a full valuation of her business. We sat down with her, and the valuation came in at about half of what she expected or wanted. And so through that conversation, we realized she says, well, I haven't raised prices in 7 years. She thought that was actually a good thing. She actually ended up retaining our consult. We actually have a consulting arm. She retained our consultants, went into the pricing study, and helped her over the next 2 years increase her prices by 20%. So over the next 2 years, she increased pricing by 20%. Obviously, that dropped right to her bottom line. And now we sold her company for 2x what she had hoped to get a couple of years ago, and 4 times what it was originally valued at a couple of years ago, because simply by doing nothing more than increasing her prices. Yeah. We don't have time to talk about truck kip. We'll move on to number 5. This is a big one and a tough one. Customer concentration issues. I get it. You start, like I said earlier, I get it. You got the tiger by the tail. It's tough to sometimes diversify, but you got to do that to the best of your ability, right? You got to get those customer concentration issues, and you might have to do so by investing. Here are all the reasons why. I actually have clients that say, well, why should my client care that all my business is with Microsoft? We're good. I actually have a story, but I don't have time to tell, but with Costco, and we actually early on in private equity days invested in a company that was 85% Costco, and they made it, the seller convinced us that, oh yeah, when we're good at Costco, we got all these different regions, different buyers, yada, yada, yada. Well, soon after we took over the company, Costco consolidated all their buyers to one, and made a long story short, we lost Costco as a client. And as we struggled to survive, and it took us a couple of years to recover from that when we thought we had a really strong situation. I learned my lesson the hard way. Customer concentration is a big issue to me, and it is a big issue to buyers. Okay, so what do I do to reduce that? Well, you got to invest in other product lines and services that go into other clients. You need to invest in marketing and sales teams to do that. It means you may have to make a significant capital investment to diversify, but you got to do it. Okay. Or if you really got this animal by the tail and you just can't diversify, then make yourself as sticky as possible with them, right? Make your products and your service so absolutely indispensable that the cost of switching is extremely painful. Okay. You can also introduce some long-term contracts. That's another way of, I've had another client in the trucking industry. We're able to introduce a very long-term contract with a client which represents about 90% of their business. And because this contract is, 5-year contract, that actually helps to add some value. And they've done these other things. They're very sticky. It'd be very expensive for the client to remove them and bring somebody else to do what they do for them. Okay, let's talk about number 6 here, recurring revenue. How do you create recurring revenue streams? And here's just a list of all different types. I talked about Microsoft earlier, going to a subscription based. Let me just tell you a story quickly about an HVAC contractor. I actually had a client that it was an HVAC contractor, and he said, how do I get these recurring revenues? You're telling me I'm at the bottom barrel. I'm having to fight and you're right. I'm having to fight for all these contracts. I win, 1 out of every 10 or so. I win, and it's a lot of work and effort, and I'm battling a day in, day out to win those contracts. How do I create recurring revenue stream? So he rethought his processes. So, well, when you put in these HVAC systems, who services them? Well, there's some service companies that do that. But why don't you do that? Why don't you put together a sales, as part of selling them the product and installing it, why don't you get them on a service contract? And I was sharing this experience at a Vistage Summit in Salt Lake City pre-COVID a couple of years ago. And there's these 2 burly guys in the back of the presentation. Younger guys, kind of burly, they look like contractors, And I shared them this story, and all of a sudden there's a big hoop and holler and a high five in the back, and they yelled, "We're doing the same thing." So they found that as well. To create recurring revenue streams, they were able to work out how to develop maintenance contracts in their situation. But try to find a way. Again, everybody's situation in business is different. I have another client that I'll share real quickly. Here was a manufacturing client, manufactured water cleaning machine. So it's machinery used like in oil pipelines to clean the yucky water, or if you have bad portable water, it cleans the water. And these machines were about the size of a container, a container ship container. And they were selling them one at a time. And they had a decent profit margin on them. But they realized that there wasn't a recurring revenue stream. They always had to go out and win these contracts and sell these things. So they ultimately ended up with maintenance contracts that they supplied all the materials for it. And then they came up with a leasing company. So, we have a lot of clients just don't have the cash flow, but don't have the CapEx to make the investment, or don't want to make the CapEx. And we found that we could actually get these things paid off in 2 years. So a 2-year payback. So they started a leasing company, started leasing revenue, creating leasing revenue. It was really a great model, and really increased their profitability and attractiveness to buyers. Okay, lastly here, we'll take a second and talk about CPA prepared financial statements. Important to have prepared financial statements. Hopefully you can get them audited and reviewed. It's important that when you go to market or when you talk to potential buyers, that you know your numbers and they're solid. And it's best that it's done by a third party outside. I know you believe that maybe your bookkeeper accountant does a great job, but it's worth every penny to pay for an audit. And I know they're expensive, but it's worth it. And I'll tell you why. If you get into a transaction and you get into due diligence on that sale transaction, and the buyer finds discrepancies in your financial statements, that's bad. There's only 2 outcomes from that. One is the buyer walks away and you lose the deal. You wasted all this time, money, and effort getting to this point. Or 2, which is almost as bad, they'll decrease the value of the transaction. They'll come back and want to renegotiate that value. I'll tell you a client I had many years ago that ended up with $1 million discrepancy due to inventory and timing of revenue recognition and so forth. And he was a $4 million in EBITDA company, took him from 4 to 3, he had a purchase price of $28 million. Now you think it'd go from 28, okay, let's just drop it 1 million times the multiple, that'd make it maybe 21 million. No, he ended up having to sell for like 18 million. Why? Because now the buyer, and then he had to take terms because the buyer now did not trust the numbers and had to, and created additional risk for the buyer. So he wanted a further discount to compensate for that risk. So it's so that little bit of money that could have been spent to understand the numbers up front cost him millions of dollars. It's worth every penny of it. Happy to talk to you a little bit more about this offline. Okay. Okay, finding the right CPA firm, you can do that. One of the best ways to do that is talking to your Vistage cohorts. Many of them are using outside CPA firms. Find out who they're using, who they like. Find somebody, hopefully, maybe has experience in your industry that also helps as well. And understand, most importantly, somebody who really understands and listens to you, and somebody you feel comfortable with. Okay, so I'm going to talk about a scoring sheet real quick. So this scoring sheet is available, I believe, on the Vistage website. It's also available on our website. I just took the 7 things that we talked about, the actionable items we talked about, and you can take that and score yourself on a scale of 1 to 10, or if you want to make this change the scale of 1 to 5, but score yourself on a scale of 1 to 10. How well are you doing in each one of those categories? And then you end up with a score at the end. And if you end up with a score that say 60 to 70, that means you're probably ready to go. If it's somewhere between 50 and 60, may need a little more work, a little more tweaking, a tweak or two. If you score a 50 to 60, it probably says there's still some more work that really seriously needs to be done. And if you're below 50, then there's probably a lot of work that needs to be done. But you need to be honest with yourself when you work through that metrics. Now we're going to do an example. I know I rushed through that a little bit, partly because we're going to do a case study here with Starfish. I'm going to take a minute and walk through Starfish with you. Okay. Starfish was a company I mentioned earlier. Starfish was a consumer products company. The owners were in their mid-50s, husband and wife were in the business. They had EBITDA north of 2 million, so nice and profitable. Their strengths, so they were very diversified customer base. Their EBITDA margins were incredible at 50%. Wow. Business was easily scalable, as I mentioned earlier. They actually had third-party GAAP prepared financial statements. Even though they're a smallish company, they had taken the time and the effort to have a third party review their financials year to year. They had no COVID-19 impact. Actually, they had a positive jump there in the home remodel and restoration space, and therefore, and a new construction space. So therefore, they were not negatively impacted. They had intellectual property rights. They had patents around their products. Their weakness was they had no secondary management team. You remember how important I mentioned that was earlier? In this case, it's just the husband and wife and one salesperson, but that's all they needed. They'd set up the model so it was so scalable. They had a manufacturing done overseas. They had a third-party warehouse where they stored it. They had distribution clients. They just shipped the stuff to their clients, and that was it. And a very simple model, but they had no secondary management team. That was almost a reason why we didn't take them on as a client. Okay, so let's talk about how they scored on using our scoring metrics here. Okay, so number one, team. The company was owner dependent, so you can see that they scored a 1, as low as possible. The company really didn't exist without the owner. Okay, so really bad there. Growth and scalability. They're growing like crazy. They had great scalability. We gave them a 9. Barriers to entry. They had patents and so forth. We scored them a 7 because those patents, you can always work around them a little bit. So we scored them a 7 on that. Margins and profitability. They had 50% EBITDA margins, that phenomenal margins. So great profit margins. Customer mix, they had no customer concentration issues. I think the largest distributor was like 7 or 8%. And they had a good solid product selling well. So the risk of losing them, and they were gaining new ones. So very low customer concentration, recurring revenue. They had all these agreements with all these various distributors, very solid recurring revenue stream. And financials, as I mentioned earlier, they had CPA audited financials, believe it or not. And so we scored them a 10. So they scored a 52 out of 70. Not a great score, but if you took the team out of it, they had a pretty good score. So let me tell you how the Starfish story ends quickly. We were engaged with them in the middle of the pandemic in June 1st of 2020. By June 21st, fortunately, they had their ducks in line. Well, that's one of the great things about some clients is they had everything really well prepared. Within 4 hours of the engagement, we had all the information we needed to do all the marketing materials. We prepared all the marketing materials over the weekend, got approval from them on the following Monday morning, and we went to market. So by June 21st, now we actually had 28 non-disclosure agreements, so 28 interested parties. 6 of them actually provided preliminary offers, which we call indications of interest, which help define how much they're willing to pay, what the offer might look like. And the valuation ranges on those indications of interest were anywhere from 6 to 15 million. Now to start with, I tell we valued this company around 12 to 13 million because it's 6.5 times their EBITDA. On July 15th, so now we're into this about 45 days, they actually ended up accepting an offer for $18 million. Okay, well above the 13 to 14 million that we had predicted. Why? Because they were a quality company, even though they didn't have the management team. So here's the key: we actually had to go out and identify potential strategic buyers that already had the team in place, or already selling into the same distributors, but who had a hole in their product line, which our client actually filled. And we were actually able to identify about a half a dozen of them. We're able to go to them, get them excited about filling that product line and not needing the management team. This doesn't happen every day. That's what I'm kind of excited about. We were able to find the right buyers and that needed that product line, that didn't need the management team. And then they started competing for the business. And so we ended up in an auction process. I said they accepted an offer for $18 million on July 15th. That was only 45 days from beginning to end. And then it was also an all-cash deal. It was 50% over our estimated value, went to a strategic buyer. Why? Supply and demand. They had capital. They needed to get it invested, and our client filled a niche that they had. And they were a quality company. So in closing, I appreciate your time. And I know with an hour it's hard to deal with all of these issues. Let me just tell you one thing. If you found yourself, after doing this analysis, going through that sheet and doing your analysis and rating yourself on how well you're doing on each one of these categories, if you're finding yourself falling short in any of them, I behoove you to perhaps look to retain a consultant who's an expert in that particular area. And where do you find that type of person? Well, Vistage is a great place to start. You got your chair, talk with your chair, talk to the people, your other cohorts in your organization, see if they've used any consultants in this space. And you also have the Vistage industry forums where you can go post and say, look, I'm looking for a consultant in a specific area. And you'd be surprised at how many people will reply to that, and you'll get plenty of opportunities. So highly recommend finding a professional that can help you, because you're running the company day to day, and you may not, and you're in the woods, in the forest. You need somebody who's had experience in other industries and other areas and understands your issue and help you improve upon that. So in summary here, I would recommend doing that. Make sure you have a strong secondary management team. Your company is growing and heading in the right direction. You can create barriers of entry around your business, keep competitors out, gives you a competitive advantage, allows you to be a market share leader. Make sure your margins are increasing, or at least staying the same and increasing on your margins, not having decreasing margins. Make your customer concentration as minimal as possible, or if you got to have it, then make it as sticky as possible. Develop recurring revenue streams within your model. It may mean rethinking a little bit of your business and how you do it. And then lastly, and most importantly, make sure you have an outside third party preparing your financial statements according to GAAP. It's worth every penny of it. Lastly, or last two, we're in a strong M&A market, as I mentioned earlier. And if you're a quality company, you're in short supply. So if you're a quality company, you're thinking about going to market, now's the time to do it. With that, Ann, I'm going to turn the time over to you for Q&A.
All right. Thank you so much, Bob. And we had a lot of great case studies through that session. And unfortunately, I think we're out of time for Q&A. But I think you answered a lot of the questions as we're going through. The question that I did want to ask is, are we able to send our participants your slides along with the recording?
Absolutely. Absolutely.
Perfect. Okay.
And if they have questions that we didn't answer, you want to send those to us, we'll put a team on and we'll get answers back to them.
Fantastic. That's what we'll do then. So thank you so much for sharing your insights today, Bob. I loved all the stories that we heard, and the scorecard is definitely valuable for our members. So we will be sending a link to today's recording and the slides within 24 hours. Meanwhile, I hope you can join us next month for two more, actually this month, for two more great webinars. Happy October. On October 8th, we have the inflation equation, what it means for CEOs, featuring Jason Draho, a leader in UBS's Chief Investment Office. And on October 29th, Vistage speaker and president of Boost Profits, Casey Brown, joins us to share insights on developing strong pricing strategy. One of your recommendations, Bob, is to raise prices. And this is part of the insights we share in our decision factors report, one of the latest Vistage research reports that'll be released later this month. So you can register for those sessions at vistage.com/webinar. That's vistage.com/webinar. So on behalf of That Capital, Bob, myself, be safe and be well. Have a great weekend.